Every finance creator on the internet is selling you the same dream. Buy dividend stocks, reinvest the payouts, and eventually you wake up making more from your portfolio than from your job. There are entire YouTube channels, entire subreddits, entire book franchises built on this one idea. And on paper it sounds bulletproof. A company hands you cash just for owning its stock. No selling, no timing the market, just sit there and collect a check every quarter. But here's the question nobody actually answers. If dividends are free money, why does the math of finance say they shouldn't matter at all? Why did Amazon refuse to pay a single dividend for the first 27 years of its existence while becoming one of the best performing stocks in history? Why does Berkshire Hathaway, run by a man who has spent 60 years explaining how to build wealth, refuse to pay one too? And why do some of the highest yielding stocks on the entire market end up being some of the worst long-term investments you could have made? So that's what we were actually figuring out today. Is the dividend portfolio a genuine cheat code, or is it one of the most effective marketing campaigns Wall Street has ever run on regular people? Let's start with the part almost nobody understands, which is what a dividend actually does to a stock the moment it gets paid. Say a company is trading at $100 a share and announces a $2 dividend. On the day that dividend gets paid out, called the ex-dividend date, the stock doesn't just sit at $100 while you collect your $2 on top. The price mechanically drops to roughly $98. The company just sent $2 of its own cash out the door, so the company is worth $2 less. And the market adjusts for that instantly. So when someone tells you dividends are extra money on top of your stock gains, what actually happened is your stock got a little cheaper and you got handed the difference in cash. You didn't get richer the moment the dividend hit your account. You just had your own money rearranged from one column into another. This is the entire basis of something economists figured out back in 1961 called the dividend irrelevance theory, built by two guys named Modigliani and Miller, and it argues that in a perfectly efficient market, whether a company pays a dividend or not shouldn't change the value of your investment one bit. Which raises the obvious question. If the theory says dividends are irrelevant, why does an entire industry exist around chasing them? The answer is psychology, not math. Watching a stock price go up and down feels like gambling. Watching cash hit your brokerage account every quarter feels like getting paid. Same underlying value, completely different emotional experience. And Wall Street figured out decades ago that you can sell people on a feeling a lot more easily than you can sell them on a spreadsheet. Now here's where it actually gets interesting, because dividends aren't useless. They just work for a completely different reason than the one being marketed to you. The real value of a dividend isn't the cash itself. It's what the cash forces you to do. When a company pays you a dividend, you have to make an active decision. Spend it or reinvest it. And the investors who reinvest it automatically through what's called a DRIP, a dividend reinvestment plan, end up buying more shares every single quarter without ever having to think about it or time the market. That forced, automatic, emotionless reinvestment is the actual cheat code, not the dividend, the discipline the dividend creates. This is also exactly the trick that made Warren Buffett's Coca-Cola position legendary. Berkshire built its Coca-Cola stake back in the late 1980s for roughly $1.3 billion. Today, the dividends Coca-Cola pays Berkshire every single year are larger than what Berkshire originally paid for the entire position. Buffett isn't getting rich from Coca-Cola's stock price climbing. He's getting paid his entire original investment back in cash every year, forever, on top of still owning the company. That's not a trick of the dividend itself. That's 3 decades of compounding doing what compounding does, and the dividend just happens to be the vehicle that delivered it. So that's the cheat code side. Now let's get into the scam side, because this is the part the dividend influencers conveniently leave out of every video. The first problem is yield chasing. The higher a stock's dividend yield looks, the more likely the market is quietly pricing in trouble. A company doesn't just hand out a fat yield because it loves its shareholders. Yields go up when stock prices fall, and stock prices fall when investors expect bad news. AT&T spent years marketing itself as a reliable dividend stock, with a yield north of 7% right up until 2022, when it slashed the dividend in half to fund its debt load. General Electric did the same thing. Investors who bought in purely chasing the yield got a double punch, the stock price collapsed, and the income they were depending on got cut along with it. In dividend investing, this is called a yield trap. and it catches new investors constantly because a high number looks like a reward when it's actually a warning sign. The second problem is taxes, and this one barely ever gets mentioned. Every time a dividend lands in a taxable brokerage account, it's a taxable event whether you wanted the cash or not. Dude, you don't get to choose the timing. Compare that to a company like Amazon that pays no dividend at all and just lets its value grow. If you never sell, you never owe a cent in tax, no matter how much the stock has gone up. Dividend investors are voluntarily creating a tax bill every single quarter for the privilege of getting their own money handed back to them slightly rearranged. In a tax-advantaged account, this doesn't matter much, but in a regular brokerage account, it's a quiet, repeated leak that most dividend investors never actually calculate. And if you've ever chased a REIT specifically for the yield, the tax hit is even worse. REITs are required by law to distribute at least 90% of their taxable income to shareholders, which is exactly why their yields look so attractive in the first place. But that same structure means most REIT dividends don't qualify for the lower capital gains rate. They get taxed as ordinary income, the same bracket as your paycheck. So the yield that looks the best on paper is often the one taking the biggest bite out of every check you receive. And the third problem is the one Wall Street profits from directly. Dividend-focused ETFs and mutual funds are some of the most heavily marketed products in the entire industry because dividended investors are loyal, emotionally attached, and far less likely to sell during a downturn than a typical investor. That makes them an extremely profitable customer to capture. Funds package up dividend stocks, slap a label like Dividend Aristocrats or High Yield Income on the cover, charge a management fee for the privilege, and sell the entire feeling of getting paid to people who would have done just as well, or better, in a plain total market index fund with a fraction of the fee. So where does that actually leave us? Dividends aren't fake, and the income is real cash you can spend. But the version being sold to you, that dividends are bonus money, stacked on top of your regular returns, that's not how the mechanics actually work. The price adjusts. The real benefit is what reinvesting that cash forces you to do over a long enough timeline, and the real danger is what chasing a high yield number, ignoring the tax drag, and paying a fee for the marketing around it can quietly cost you. The companies running the most successful long-term compounding machines in history, the Berkshires, the early Amazons, mostly didn't get there by paying out cash. They got there by keeping it and reinvesting it themselves at a higher rate than you could have. A dividend is just Wall Street's way of admitting it ran out of better ideas for your money and decided to hand it back to you instead. So is it a scam or a cheat code? It's neither. It's a forced savings habit wearing the marketing costume of free income, and whether that habit makes you rich depends entirely on what you do with their check, the moment it lands in your account.